And let's go other side of the coast, California. Talk with Doug. Doug, you're with Allworth Money Matters.
Hello.
Hi,
Good
Doug.
morning. Hi.
Good morning.
I've been fighting a situation since last year. I have, over the years, since 1986, I've been doing IRAs. But through the years working, I've had pension. So those years, obviously, I couldn't contribute, or at least I couldn't take the pre-tax
That's
deduction.
Right.
What I'm trying to figure out now is over the years, again, I'm talking since back in 86, over the years, my IRAs have been merged with my pre-tax versus post-tax contributions.
Yes.
I filed an 8606 form with the IRS back in 2010, which was my last year of working. And I've got about $35,000 in post-tax or after-tax contributions to that IRA. And my total...
I'm sorry, say that number again. How much?
35,000.
Okay, 35K.
35,000, yeah.
Okay.
Out of a total of 368,000.
Okay.
Okay. How or what can I do to avoid paying RMDs, or can I take that money out of that traditional IRA and say put it in a Roth? Or how can I remove excess funds? I'm just trying to figure out how to.
Yes.
I've talked to a tax advisor. She couldn't help me. I went to the IRS. The guy was an idiot. I'm sorry to say, but he could not help me. I knew more than he did. And I called one guy, a CPA, and he said, "No, you just need a tax advisor." So I'm really confused.
Isn't that a CPA?
I'm sorry?
Isn't the CPA a tax advisor? No, not all.
Well, yeah, but I asked him if I need, a tax preparer, I guess. I don't know. But he said I did not need a CPA.
So how old are you?
I'm 73.
And you're not, and you're no longer employed. Do you have a 401k anywhere?
No, I pulled them all out when I retired.
So the way the rule works, Doug, is if you took, let's call it roughly 10% of your IRA balance is after tax money, right? So 35,000 of 368, let's just call it 10%. It's roughly 10%, 35 of 368.
Okay.
So 10% of your IRAs you've already been taxed on because you contributed with after-tax dollars.
And you have and you've memorialized that every year with your 8606
That's right.
with your tax return.
So
okay, now a question on that. The last year I worked was 2010.
Okay.
Am I required to send a 8606 every year since that time? Because I haven't.
I believe.
I do. I don't know whether you're required or not, but I did every year until I was able to fix the problem. I fixed my problem a little bit differently than we're going to tell you to fix your problem. But there's no downside. I remember we asked this, Scott, I remember asking this question.
You still might file the 8606. I have no idea.
So the accountant said, even if it doesn't require, why wouldn't you?
Yeah.
Right? It's the same form every year. Your basis never changes.
Yeah. So right now, if you took out $10,000 or wait till your required minimum distribution, let's just say you took out $10,000.
Okay.
Of that, $9,000 will be taxable and $1,000 will be tax-free, roughly 10%.
Right.
And I assume that's how you're doing it.
Okay.
You haven't taken it.
I haven't done anything yet.
Okay.
That's why I'm calling.
So one option is just to say it is what it is. When I take my required minimum distributions, whatever that number is, roughly 10% of it is already taxed, and it's just a pro-rata formula. It's based upon what percentage of your IRA assets have been taxed versus what percentage haven't been, and that portion comes out tax-free, and the rest becomes taxable. But you need to do the calculations because your IRA provider's not going to have it.
You do the calculation. Now, I'm going to answer a question that's going to come to you after you hung up this phone call, which is why can't I just take that $35,000 and convert it to a Roth IRA?
Because you can't.
Yeah.
Because that takes place on a pro rata basis as well.
Yes. So if you said, let's assume you even had the account separate. Let's assume that when you set up those IRAs at the bank, which I'm sure you did back in the 80s because interest rates were high, you set them at the bank at $2,000 per year. You were not allowed to take a tax deduction. Let's assume that was still in an intact account. Even if you took that and converted to a Roth, when it comes time to doing your taxes, they're going to say, no, we don't look at it like that. We look at all your IRAs. Now,
Okay.
if you are still employed
and had access to a company 401k,
you could say, I'm going to transfer 90% of my IRAs to my current employer's 401k and leave behind just $35,000 in an IRA.
which is the after-tax amount. And we're answering this for the rest of the listeners. This doesn't apply to you
you don't
unless
have
you want to
Right.
go back into the
And
workforce.
by the way, it's murky on whether this is permissible or not. Because I've heard two different tax opinions on it.
So
Because you can put money from IRAs into 401ks. It's the whole sort. And I've heard different tax.
it's the sourcing of it that's questionable.
And it
So-
doesn't apply to you
for
anyway.
For you, you don't have any choice. You're going to have to pay taxes on it. It's RMD. You can't convert
And if you
it
say
to a Roth.
if you say I want to convert 20,000 to a Roth this year, whatever the number is, great. At 90% of that is going to be a taxable conversion, and 10% will be tax free because of your cost basis in your IRAs.
Which may actually be the right thing for you to do is to convert to a Roth.
Probably not. At 368, if this is your retirement,
Well, how much income do you have?
I'm sorry?
How much income do you live on every year?
Oh, man. Probably close to 100,000,
Yeah, it's probably not.
between me and my wife.
Yeah.
Yeah. I mean, your
Yeah,
your required minimum distributions
pretty low.
Yeah. Just
Yeah, well, it's the required minimum distribution came out to about not quite 14,000
That's
Okay.
right. Yeah.
for this year.
Yep.
and of that, roughly 1,400 is going to be tax free, and the rest will be taxable.
So that's
Now,
the
is
answer
that-
to your
is that-
question.
Is that something that's on the IRA form to clarify the difference between taxable and post-tax?
I don't know how the forms work. I don't file my own taxes, but
That's the rules.
Okay.
That's
okay.
the rules.
Yeah.
So yeah, you don't have to call anyone else.
Okay.
Yeah.
Okay.
Yeah.
It's very frustrating. Trying to find stuff out is very difficult.
Well, look,
you just found it out. Life's simple now.
This I gotta tell you, this drives me crazy. Drives me crazy under this new proposal for this big beautiful bill. Right? The
Yeah.
big beautiful bill. You look at all these little things that are like, okay, so the first $10,000 in SALT, but not after the SALT, and then comes here. Oh, and then
You mean making the tax code even more
you're
complicated?
just thinking this is it's complicated. It's
That's why
complicated.
the tax code is so complicated.
Un-
Because every tax bill makes it more complicated,
That-
not less so. No, there's no simplification.
Right.
Correct.
It just gets more and more complicated.
Yes.
Yeah. Tell me.
Right. Oh, and then there's and then things come out of the blue like, oh, you're 520. A couple of years ago, oh, your 529 plan, you can now convert it to
All kinds of stuff.
to a Roth to an IRA.
There's all kinds of crazy
Like
stuff.
this applies to what 000.
Doug-
Wait, I'm in the middle of a rant here. He's listening. This feels good.
To talk to you. A computer guy would say, my RAM is full. I can't take in anymore.
All right, Doug. Appreciate the call.